Hello and welcome to another Wealth of Advice market update on the 11th of April 2023. For those clients who watch this market update regularly, you may have noticed that I haven't been present on the last two that we've recorded. That was purely down to the fact that I had a cold since Christmas that just wouldn't go away, and every time we came to record a new update, I sounded really bunged up and horrible. Thankfully now that's gone. I even have a little bit of a tan because I've just been away on holiday, and thankfully I come back to record this with the first quarter of 2023 completed from the January the 1st to the 31st of March 2023. We've seen a positive return for markets over that 3-month period. Yes, there's been a lot of volatility in that 3-month period. However, if you are the type of client who only logs in to check your valuations every few weeks or every couple of months, anyone logging in on the 1st of January and comparing it to the end of the 31st of March should have all seen positive returns over that 3-month period. As we'll come on to explain during this update, there was a lot of events and a lot of situations going on in the world which caused markets to react in quite a volatile way during that period. But the first chart that you can see on your screen right now shows how markets have performed over the first 3 months. The FTSE 100 is the best performing index since the 1st of January 2023, up almost 4%. If you do look where we were mid-February, for those greedy clients watching, I'm a greedy client myself, the FTSE 100 was up 8% from the start of January till then. Then, as you can see, in mid-March we had quite a bit of a comeback. I wouldn't call it a crash, but certainly a pullback, and that applied to the FTSE 100, the MSCI World Index, and also the S&P 500 across in America. All markets fell quite a bit during the month of March, but thankfully as we got to the end of that first 3-month period, all markets, the S&P up over 3%, the MSCI World Index up 3.8%, and the FTSE 100 up 3.98%. So very, very good positive start to 2023. I've said on previous updates that we're not going to mention 2022 ever again because it was such a terrible year. However, 2022 behind us, first 3 months of 2023 positive. That's all we really could have asked for on the 1st of January, is that we start this year with a positive quarter, and hopefully, as I say, people are feeling a little bit more positive now than where we were at the beginning of the year. So why did markets perform the way that they did during the first 3 months of this year? As I say, volatility was quite high. Risk was back on as we got into the month of March, and that was really around the issues regarding Silicon Valley Bank and Credit Suisse. What came out of that situation was we found that those situations were really company specific. Yes, there was more than those two companies involved, but it wasn't something that spread as a massive contagion across the entire banking sector for a prolonged period of time. Yes, there was that 10-day period when Silicon Valley Bank went bust and everyone was worried what was going to happen with Credit Suisse before they were eventually bought out to kind of bring an end to that mini crisis, but it certainly didn't spread in the manner that the financial crisis spread in 2007, 2008, 2009, which a lot of people were fearing for. All those people in power stepped up and said we need to stop this from spreading, so the contagion was kept in check. And thankfully, as I say, as we ended March, markets at the end of March were quite flat actually, but they had recovered somewhat from those falls that were seen when this bank got into the trouble. But the episode really shows to central banks and to governments the implications of increasing interest rates, because interest rates have now been increased for coming up to over a 12-month period now. The US started raising their rates and then everyone else sort of seemed to follow suit. So everyone in the world was saying we have to increase interest rates to keep a lid on inflation or help bring inflation down, because higher interest rates will stop people from spending as much money as the theory, and therefore inflation gets in check. However, the knock-on effect was all of these banks all over the world which had money deposited in certain bond funds, and these bond funds were bought prior to interest rates going up, were getting a lower rate of interest as what they were paying out. So the rising interest rates really had a negative impact on banks and banks' balance sheets. So, for instance, the Federal Reserve has acknowledged in America that they have to keep an eye on this, and therefore that may mean that interest rates going up higher and higher. This is the kind of the sign to say that's not going to happen. Yes, they did increase rates slightly again, but the markets are now hoping that the speed and the actual amount of bank interest rate rises is now going to stop. And again, we're now starting to hear murmurings that rates could go down at the end of the year. But we shall see on that. For those people who've watched these updates many times over the years, we've always referred to the VIX Index when we've talked about a measure of risk. The VIX Index tries to measure the actual level of risk that exists in a market at any one time. As we got to the end of February into March, the VIX Index spiked right the way up with this banking crisis going on. So clients who are investing in our model portfolios, or clients who are investing with Royal London, for example, may think, well, that's a definite point for us to be making changes to how the funds are invested. Should we be taking risk off immediately? Obviously, we took advice. Royal London have got their asset allocation team, and they're all looking at this on a daily basis, as we were with our portfolios. And we decided not to make any changes at that point, because all the evidence that we were getting from the experts was that this banking situation was going to be affecting just a small number of banks involved, and that turned out to be true. So we felt there was no reason to make any changes at that time. And just to compare the VIX index from February into March, how it rose quite a level there. You go back to September and October of last year when it was much higher, and also the 2 points in 2022 in June, and obviously in April it was much higher then. So although this was a risky period, it wasn't as high as what it was at some points over the last 12 months. And thankfully, after we saw Credit Suisse being bailed out and saved, the VIX index has come right the way down, and it's below the long-term historic levels that we look at as to when we feel markets are in a much safer place. So thankfully that's where we are. If we now look at the VIX index over 15 years, and the reason I've chose 15 years is because it includes the financial crisis of 2007-2008. You can clearly see that the financial crisis then was only comparable to COVID in 2020, but everything that's happened sort of since, and what's been happening in more recent times, the war in Ukraine, the rise in interest rates, the inflation problem, the banking situation we had back in March, it hasn't come close to what COVID brought and what the banking crisis of 2007-8 brought. Yes, there's been some spikes along the way, but the thing that you'll notice with 2008 financial crisis, how it ended, we're getting this on the screen now. It shows the volatility index from 2008 to 2012. You can see that the volatility index really spiked when the financial crisis was at its height, when Lehman Brothers went bust towards the end of 2008, and then it came right the way down. And we talked to clients about this period in time and saying the clients who were invested all the way through this period really saw an end to the financial crisis around about March 2009, which correlates with how that graph goes down there. But interestingly, as you can see, as we come out of the financial crisis towards the end of 2010 there, past July 2011, you can see that there was a spike in the volatility index as we came out of that big financial crisis. And I feel that's kind of just what we're seeing right now with the banking situation a few weeks ago. When you come out of any huge, massive crisis like COVID was, there will be some hiccups along the way. There will be some worrying moments when you think, oh, crikey, it's happening again. But as you can see from the longer term graph, which is back on the screen now, the 15-year index, you will see that across that 15-year period, there has been jumps along the way when it would bring fear and it would bring worry to investors, because your valuations will come down a little bit. But thankfully, as you can see, over the long run, it comes back to its natural level, and people make money over the long run. And just continuing on that point of what happened after the financial crisis, just to bring it to life with regards to some actual numbers, you can see that from January 2009, which, as I say, I always tell clients it's around about March 2009. You can see that from the drop on there when markets hit their low point. But from January 2009 up to the end of 2012, markets, the FTSE 100 up 40% over that period, the S&P 500 was up 35% almost over that period, and the MSCI World Index just up over around 29% over that period. It also shows as well that although there is some big jumps up and down across that 3-year period, that markets are generally positive over a 3-year period after the big financial crisis that happened then. And again, we're hoping right now that as a result of what happened with COVID coming to an end of 2020, we got into 2021, markets jumped up nice across that period. 2022 was the absolute bloodbath. We said we're not going to talk about it anymore. What I'm looking at now is the next 3 years, and the next 3 years to me can be very positive, and I hope that we are now on the start of a positive period in time again. But what should be noted, like what we saw 10 years ago, is that there will be some drops along the way. There will be some news stories that come out which frighten the markets, which spook the markets. That happened again in March, but it's to be expected, and hopefully, as I say, we come out the other side in a much more positive fashion. So now when we look at how markets have performed over the last 12 months, the FTSE 100, again, the best performing index on there, reached an all-time high. You will remember the news channels telling you end of February, just before you can see it dropping down quite a lot. So although the FTSE 100 was at an all-time high at the end of February, it is the best performing asset in the last 12 months because it's full of oil companies and the oil price had done very well, and mining companies and such like. But going forward, I'm not a huge fan of the FTSE 100 because of how it's put together, the companies that are in there. You start to see some companies decide not to list on the FTSE 100. Technology companies go across to the US more often, for example. So although the short-term performance does look good on that, again, when you look at the 5-year performance, you can see S&P 500 is up 83.5%, MSCI World Index is up 63.69%, and as I say, the FTSE 100 is up 28.86% over the period that we've got on the screen there for you now. So it does pay to be well diversified, have your investments spread across all of the major markets, which we do, which Royal London does, which Prudential does. So it doesn't matter how we have your funds invested, we always will have you diversified and invested across the world. And crucially, it's making those changes at the appropriate times to look at what's going to happen next. So if you could give me 83% performance over the next 5 years, I would be absolutely delighted. Do I think it's going to happen? I'm just not too sure right now. Why would I be more sure? Well, we need more certainty in the market. We need to know what's going to happen in the coming 12, 18 months. There's a general election going to happen in the UK. There's a general election going to happen across in the US. There's lots and lots of things that are going to happen. What's happening with the war in Ukraine? What's happening with China, Taiwan? So there's lots of uncertainties there. But once a lot of those uncertainties become certain, I'm pretty confident markets will pick back up and provide the positive returns that we also so really want. Why should I be confident that's going to happen? Companies aren't going bust. Companies are making record profits. So although inflation's been an absolute killer for many consumers, companies are taking their advantage of this and putting prices up, and a lot of them are getting away with it. So there's definite reasons why the next 5 years could be quite positive as well. So now try to end this presentation on a positive note, and the chart that you can see on screen shows you the recent market corrections, i.e. when a market has crashed going back to 1987 and how it recovered in the period thereafter. You can see there markets fell by over 33.5%. The immediate recovery in the 12 months after was up 21.4%. The Gulf War, 1990, I remember that one very vividly. I remember watching that on the TV when it was happening as a child. Markets went down 19.9%, bounced back 29.1%. You can see other crises along the way. A big one, the financial crisis, which we've mentioned in this presentation. 56.8% down markets were at that point. So those clients who think they have it bad right now, I know you've got it bad right now, it's not good, and it's not a good feeling to live through this, but those people who are in drawdown, and I still have a good number of clients who were in drawdown during this period, you were down 56.8%. At the worst of the financial crisis, markets then bounced back up over 68%. Trade wars, when Trump was falling out with China in 2018, that's probably the most recent problems we had before we got to COVID that we can all remember. COVID on there minus 33.8, but then bounced back 77. And I've said to many clients in presentations, I think that bounce back of 77 was an artificial bounce caused by world leaders pumping so much free money into the world through bounce back loans, furlough payments. Everyone was just awash with this free money, so markets did bounce back massively. And you can see the 23.9% fall during 2022. How will that recover? Well, that's to be seen, but hopefully it's a bounce bigger than the 23.9% that we saw previously. As most of these corrections have seen, you will get a big bounce back in the 12 months after the shock of what's happening there. So thanks for watching another Wealth of Advice market update. I hope you found today's presentation informative, useful, and hopefully a little bit uplifting. I'm more positive now than I was on January the 1st. So hopefully clients should feel the same way as well. Good news stories will hopefully start to come through and markets will start to go up in the not too distant future. That said, we're always here for any client queries, inquiries, whatever it may be. If anyone feels a little bit unsure or uncertain about anything, please don't hesitate to get in touch. And we'll keep sending these updates out at regular intervals going forward. Hopefully I don't have the flu or the cold again this year. I couldn't cope with that. It seemed never to go away during January, February, March. But here I am back again, and hopefully you all enjoyed it. Thank you.